Hey everyone, Lewis here. Welcome to the channel where we talk about finance, real estate, and investing. In today's video, I'm going to share with you a tool that investors use to quickly size up a market and determine if a rental property will cash flow from day one. It's called the rent-to-value ratio. So I'm going to show you what it is, why it's used, why it's important, how to calculate it, and when it works well and when it doesn't work so well. Let's get into it. All right, so let's get into what the rent-to-value ratio is. The rent-to-value ratio is a percent defined as the monthly expected rent for a property divided by the purchase price. In general, the higher the rent-to-value ratio, the better an investment. An ideal rent-to-value ratio is 0.7%, and 1% or higher is considered excellent. So let me explain that in plain English. So it's a simple calculation. All you do is you take the expected monthly rent for the property and then you divide it by the purchase price and it gives you a percentage. And then you take that percentage and you look at that RV ratio and then you determine whether or not the property will cash flow. It's essentially a barometer or a way to check how strong that investment will perform. So let me give you an example. Let's say you're looking to purchase a property that is $400,000. And the expected monthly rent on that property, if you're going to turn it into a rental home, would be $2,000 per month. So you would take the $2,000, divide by $400,000, and then it would give you a 0.5% RV ratio. Now, according to the definition we found here on Google, anything under 0.7% is probably going to lack cash flow. Because there won't be enough rental income coming in to service that rental property and cover all of the expenses. Now, every single market is different. This is just a general look it's a test or a barometer to kind of gauge how well a property will perform. So what you need to do, and we'll save this for another video, is you need to determine what the expenses are on your rental property and what RV ratio would be acceptable in the area that you're looking at accumulating rentals. In general, 0.7% or higher is what you want to target. A lot of investors, depending on the markets they're investing in, they actually target what they call the 1% rule. They're looking for RV ratios that are 1% or higher. So now that you know what the rent-to-value ratio is, I'm going to show you how to apply the RV ratio in real life and exactly how to kind of size up a particular market that you're maybe identifying as an area where you'd like to accumulate rental property. So I have Zillow up on the screen here. We're going to take a look at Sacramento, California, which is right now considered one of the hottest real estate markets in the country. And we're just going to pick a couple houses at random here to get a general feel of where these RV ratios are. So I type in Sacramento, California, and there's a couple closed sales that pop up right away. Let's take a look at this first one. Okay, so this particular property, 3-bed, 2-bath, sold for $370,000, and that closed, looks like yesterday. So let's go ahead and keep in mind that Zillow has accurate data on sales, but it doesn't necessarily tell you exactly what the rental rate will be. It doesn't take into account, quality of construction, amenities, proximity to certain, things, and location, things like that. So, but it does give you a general idea of what this property will rent for. So if we're scrolling down, we can take a look and see that Zillow is estimating the rental rate on this property at $18.95 per month. So to calculate the RV ratio, what do? We take the monthly rent, expected rent, $18.95, and keep in mind, this is just an estimate here. So we take $18.95, and we divide that by the purchase price, which is $370,500. That gives us an RV ratio, if you move the decimal point over, at 0.51%. So based on the general rule of thumb, this property is likely not to cash flow very strongly because it's under 0.7%. Now, we don't know all of the expenses for this particular home, and we don't know the situation with the financing, whether they paid cash or put a large amount of money down, but in general, the numbers aren't very good here. You see what I'm saying? Let's take a look at another property. So if we're looking at another property, here's one that just sold for, 3-bed, 3-bath, 1,631 square feet in Sacramento, sold for $395,000. Let's scroll down. and get an idea of where this property might rent for, or what it might rent for. Okay, this one is looking a little bit better. The rent on this one is $2,100 per month. And if we divide by the sales price of $395, we have a 0.53% RV ratio. So slightly better, not great. We're still under 0.7%. It's not a good indication that this market will cash flow very strongly. So now let's talk a little bit about when the RV ratio works really well and where it doesn't work so well. Like I said, it's a great tool to quickly size up a market and gauge, if a property will cash flow from day one. And the reason is because it gives you a general idea of where the market's at. So like you saw in that example in Sacramento, we pulled up a couple properties that sold for around $400,000, and we determined quickly that the properties would rent for about $2,000, giving you an RV ratio of about 0.5%. Now, based on the rule of thumb given to us in that definition, anything under 0.7% is probably not going to give you very strong returns because it's not going to have a lot of cash flow. But the important thing to understand here is that the cash flow is going to be determined based on the expenses of the property and the debt that you have to service. So even though it gives you a general idea of where that market is and whether or not it'll be an area that has really strong cash flows, it doesn't break down the expenses of each individual property. So if you're an expert in a specific area, or if you have an edge in a specific area and you know the market really well, it's all about finding motivated sellers. So maybe you can go out and get a property at a lower price and improve that RV ratio. Or maybe you're looking at a property that's a fixer-upper, and after you clean it up and you put some money into it, you can attract a great tenant and command a higher price for the monthly rent, therefore improving your RV ratio. The other thing that I want to mention is that the RV ratio provides general information for the market and general information for the home, but it doesn't take into account the quality of construction, the amenities, the location, the proximity to amenities that you really like to use. And so it's not giving you a specialized market rent for that specific home. It's just giving you a general idea of where the comps are. It doesn't mean that it's not accurate. It just means that it's not specific to that property. So it's all about knowing and understanding your market and then acting accordingly. All right, so that's all I have for you today. Thank you so much for watching this video. If you found the information helpful, please feel free to like, subscribe, and share the content with your friends. Have a great day. Take care.